You're now listening to the Tax Smart REI Podcast, the number one tax podcast for real estate investors. Hey everyone, thanks for tuning into this week's episode of the Tax Smart REI Podcast. As we're in Q4 right now, this episode is being recorded towards the tail end of October. It is that time of the year to start thinking about year-end tax strategies and what you can do, what levers you can pull in order to finish 2025 strong. And that's exactly what we're going to be covering today. We're going to be going through vehicle deductions, short-term rental considerations, reps, cost seg timing, SALT deductions, and so much more. This is an episode you don't want to miss. If you are planning to make any moves before the end of this year, stay tuned. We'll be diving into all of that in just 1 minute. You've probably never found a real estate newsletter worth reading, and that's because we hadn't created ours yet. The REI Daily is a newsletter you actually want to read. Whether you own one property or 100, we created this for you. Each issue delivers crucial tax saving strategies, legislative updates, as well as real estate market insights. Everything you need to stay sharp and ahead of the game. Get the real estate and tax news that actually matters straight to your inbox. Subscribe to the REI Daily newsletter today at therealestatecpa.com/subscribe. That's it for now, and right back into today's episode. All right, and we're back, and I promise you we'll be getting into year-end tax strategy in just 1 minute. However, I've been taking a lot of discovery calls recently with potential clients and been hearing a lot of great feedback here on the podcast. So really want to appreciate everybody who tunes into this show. We wouldn't be doing this if it wasn't for you. So thank you again for tuning in. Some of the feedback that I had received is we want more commercial real estate. So I'm going to be looking at how we can talk more about commercial real estate here on the show in the coming weeks and months and weaving that in there because to be very fair, it is a topic that we've not touched on enough here on the show. If you are interested in that, though, you can check out the Major League Real Estate Podcast with Matt Hamilton and Nate Sosa, out now on Spotify, YouTube, Apple Podcasts, wherever else podcasts can be found. They do sometimes talk about that there. Also, got some feedback about more accounting content here on this podcast. I was a little surprised to hear that, to be honest, but it welcomed the feedback nonetheless. So we'll be sure we'll be touching on that as well. And then the last thing I will mention is that someone gave me feedback that the advice we gave here on the show, quote unquote advice, and I'll get into that in a second, did not apply to their situation or that they misapplied it to their situation. And what I just want to remind everybody who is tuning in, while we do share, we do give away all of our secrets here on the show. And we do probably give a level of detail and nuance that goes beyond what other people might do, other people in this space. It would be virtually impossible to go through every single detail that may apply to your personal situation. So really what you're doing here is with this show and really any other content you might find on YouTube or out there on the internet is this is helping you understand what is available out there for you. And then so you can go have constructive conversations with your tax advisor on how this all fits into your situation. So you're piecing the puzzle together in such a way that makes sense, because it's really easy to overlook some details or some nuances and blow up your strategy because it sounded like it was easy, okay? Or that you had all the information. So bottom line is what we talk about here on the show is high level. And while we do try to give as much detail as possible, we'll never be able to practically give every single nuance and thing that could come your way. So please do take this information, speak to your current CPA before implementing anything so that you can make sure that you're doing it appropriately and in compliance with the IRS. All right, so I'm getting off my soapbox. Again, thank you everybody for tuning in. Love to have you here. If you know anybody who is interested in real estate that might benefit from the show, please share it with them. That's how we spread the word. But with all that said, we're going to dive into year-end strategies here. And Justin, let's just kind of start off with what is your top strategy for year-end?
Yeah, that's a great question. There's a lot. I don't know if I'd necessarily put, ones on like a higher level of importance per se, but I will say like one of the ones that quite questions or topics we get a plethora of inquiries about like this time of year is definitely ways to utilize like the vehicle deductions. For anybody who, isn't like real familiar there are ways for you to say purchase a vehicle in your rental real estate business. And potentially now, thanks to the 100% bonus depreciation coming back, thanks to the big, beautiful bill, that you could potentially write off the entire purchase price of the vehicle, as well as all the other expenses that you have with it, like fuel and insurance and maintenance and things like that. And the key thing to keep in mind on this in order for this to work is you have to have at least 50% business use of the vehicle. But ideally, you want to keep it as close to 100% as possible, because even if you're at 95% business use on the vehicle, you only get to take 95% of the deductions,
Right.
essentially. So, and the reason why I say like, we get inquiries around this a lot at the end of the year is it is granted, you have to, it's a cash outlay, right? And maybe you get a loan for the vehicle as well. But like I said, it's a relatively easy lever to pull. It's not super like labor intensive as compared to some of the other real estate strategies where we're talking a lot about getting material participation hours and things like that. So other key considerations there too is if you want to be unfettered on the amount of deductions that you can take there, ideally you want to go for a vehicle that's over 6,000 pounds gross vehicle weight, so the GVW on that vehicle, because if you purchase a vehicle below that, there are limitations on how much depreciation or Section 179 expensing that you can take on the vehicle. So if you're wanting to be able to just maximize that completely, you're going to want to go for that 6,000 pounds or greater. That's like most of your full-size pickup trucks and
Yeah.
even a lot of crossover
Yeah.
SUVs and things will fall into that category.
No, for sure. For sure. Vehicle deductions, definitely one of the more popular year-end strategies. To your point, it's really easy to execute. Two things I'll leave here is that A, you don't want to let the tax tail wag the dog. You really want to ask yourself, do you have a use for the vehicle? Or do you need a new vehicle? Or could you use a new vehicle? You just don't want to be purchasing vehicles just for the tax deductions. Obviously, there needs to be some utility to it for yourself to make it a prudent investment purchase. So just kind of keep that in your back of your mind. Additionally, one of the reasons why it is really good from a year-end perspective, and Justin may have mentioned this, is that your deduction is going to be based on your business use in the first year, right? So if you buy it towards year end, it could be possible you could use it 100% for business, or at least very, very close to it, and then get the full write-off using 100% bonus depreciation, assuming the vehicle qualifies, right? And then in subsequent years, you only have to use it more than 50% for business, right, to maintain those deductions. So year end can be a great time to acquire these. But of course, the next question we're going to have is what about short-term rentals? And we've been getting this question a lot. And we're not going to spend too much time on short-term rentals here on this episode, I promise you. But we do get question, is it possible to do a short-term rental at this time of the year in Q4? And what precautions do you need to take? What do you need to be making sure that you're doing in order to lock that in?
Yeah, it's definitely possible, right? So it's a heavy lift going into the fourth quarter. Like Tom said, we've talked really extensively on all the requirements around short-term rentals on other episodes, but I mean, just mentioning quickly there, the big one, getting 100 hours of material participation time and more than anybody else, before the end of the year is pretty tough. We have clients that do it every year though, and the other part that makes it feasible to be able to actually do that is that spouses can combine their hours there too. So like 100, it sounds like a lot, but if you kind of break that out into, well, if we really plug away on this, we do a lot of the setup ourselves and things like, okay, two people realistically could get 32 hours in one weekend racked up, just 2 8-hour days working together, quick math there, 32 hours. So it's definitely possible. You got to be willing to really commit and put the pedal to the metal
Yeah.
though on getting the hours in for sure.
Yeah, no, for sure. Definitely still possible. We see it every year, people doing this up till November and December. So if you're diligent, you got your ducks in a row, you're making the moves. It is certainly possible. What I would say here, short-term rentals, just make sure you get at least 2 guest stays, right? You want to make sure you have the average. Those guest stays should be with third parties paying market rates to avoid any potential crossover with personal use. Document your time. And again, don't let the tax tail wag the dog. Don't rush into a property. Don't rush into a property that may be a poor investment just for the tax savings here at year end. You want to make prudent investment decisions. And also just remember that bonus depreciation is here to stay. So if you can capitalize on this in 2025, all the better. But guess what? Next year, you have the entire year to capitalize on it too. So got to put some things into perspective sometimes. One last thing I want to touch on this, Justin, and I know this is not related to directly short-term rentals, but it is something that we've been running into a lot. I've seen this a lot on the, on discovery calls with potential clients is I know there's some ambiguity around the date, place, and service, or people feel like there's ambiguity around the date the property's placed in service to get eligible for 100% bonus depreciation in 2025. I know it's not specifically year end, but can you touch on that a little bit?
Yeah, the first like weird detail is that if you had a property that was acquired or was under a binding contract, what's quote unquote air quoting here, a binding contract before January 20th, so like up to January 19th at the beginning of this year, then it's possible that it would have to be treated under the original 2025 tax rules, which were 40% bonus depreciation. And we've actually had a lot of clients. I didn't think that 19 days was going to make that big of a difference. Quite a few people that were in that boat. So you definitely want to check that out. And again, review contracts. If you did have something that was under contract that maybe didn't close until February, but you had that under contract, if it was under a quote unquote binding contract, like prior to January 20th, then it would potentially still be subject to 40% rate instead of 100% bonus depreciation.
Yeah, no,
So
100%.
It was a little tricky.
100%. That's where the devil's in the details. There's things to be aware of and why. Just want to make sure you're speaking to a tax advisor about how this all applies to your specific situation there. All right, moving along from short-term rentals, we do have the real estate professional status here, of course. Now, the one thing I'll say on the real estate professional status before I kick it over to you, Justin, is that if you've not already started the real estate professional status at this point in the year, you've not been working towards it for a significant portion of the year, getting it starting fresh from end of October through the end of the year is maybe not impossible, but extremely challenging, if not just unlikely to actually come through to fruition. Something to keep in mind with the year-end timing there. But what do you think, Justin, needs to be taken into consideration for reps into year-end?
Yeah. If you were starting today, I would say almost impossible, right? There's roughly 70 days left in the year, so you'd have to get 10 hours a day, give or take, every single day, and not take a day off until the end of the year to be able to get there. So that would be pretty tricky. I would throw out one other consideration, and this is another one of those subtleties that, depending on your situation versus another person's, right, is just the place and service considerations there too. Again, we talked about the whole beginning of the year thing, but if you're talking more about at the end of the year here, and this is where some of that dichotomy and some of the confusion around there, if you get out online and look at forums and stuff like that, where people disagree about this place and service and, with short-term rentals, they should be in service before I even get any stays. And it's because there are really two different considerations there. The place and service is just that the property it's basically rent ready. It's available for rent. There's nothing in the code that says you specifically have to have a tenant move in to the property to be considered place and service. And that's partially because place and service considerations are addressing all assets across all industries. So it's a little broad, it's a little vague. But so if you are achieving real estate professional status and you do have a property that's potentially, say you close on it November 15th, November 30th, and you don't get a tenant in before the end of the year, that doesn't necessarily mean it's not in service. If it was fully ready and you can prove that it was being marketed, listed for rent, maybe you're getting inquiries via your property management software, something like that to be able to document, hey, this thing was ready to go. We just didn't have anybody physically move in until January. It could still be considered place and service based off the rules. This is completely different, though, than what we were just talking about, short-term rentals needing to get a couple of stays. The reason why that's different, why that's important, is because for the short-term rentals, you have to be able to prove the average period of customer use is below 7.0 or less. And you can't do that without any stays. And that's been, we've discussed that in previous episodes too, but that's been established by a lot of case law over the years. So that's where that, I would say that confusion comes into play and that dichotomy comes into play if you're looking at, conversations around when does the actual place and service date happen?
100%. 100%. That's super key, the nuance there in between reps and short-term rentals. It's that time of the year again. The new year is right around the corner. If you've been listening to the podcast all year thinking, I really need to get proactive about my tax strategy, then this is your moment. Because the truth is, you probably don't even know how much money you're leaving on the table. At Hall CPA, our team helps real estate investors and business owners save thousands of dollars through proactive year-round tax planning. Whether you're looking to optimize cost segregation, leverage the real estate professional status, or short-term rentals, or structure your investments for maximum tax efficiency, then we've got you covered. But here's the deal. Spots for new clients are limited as we approach year-end. So if you want to lock in your strategy before tax filing hits, don't wait. Check out the link in the show notes to request a consultation and start working with our team before you miss another opportunity to keep more of what you earn. Next up, we have cost seg timing, right? So cost segregation does not need to be done before year end, okay? Some cost segregation companies may suggest or insinuate that it has to be done before year end, perhaps because they have quotas to meet. However, you have up until you file your tax return in 2026 to do a cost seg study. So if you bought a property in 2025, for example, you can do a cost seg study in January or February or whatever the case may be, and you're in good shape. One thing I do want to add in here while we're on cost seg timing, before I kick it over to you, Justin, is for people, and this kind of crosses over with reps a little bit, this is not going to help you if you're using the short-term rental loophole. It's going to basically be for reps or passive investors. Is If you're looking for losses to offset, say, your W-2 or your business income or your spouse's W-2 or business income, and you do one of your spouse, you or your spouse, qualify for reps, and you're doing a married filing joint return, one way to get losses in the books before the end of the year is to invest in syndicates and funds, right? We're going to generate losses, and you can group them with the rest of your long-term rentals. Now, you do have to spend more than 500 hours typically on your long-term rentals to make this work, so that when you group it all in, you're making sure you're spending more time than anybody. The 500-hour test is you're in the clear, and that's really what makes that grouping election work. But did want to point that out, that investing in syndicates and funds makes sense at this time of year for the tax savings. Or on the flip side, say you sold a property or you have significant net rental income, investing in syndicates and funds, if you're on the passive side of the coin, can also be a good play. And of course, I have to wrap it all up here, my spiel, with saying, don't let the tax tail wag the dog. Invest in good syndicate and funds that meet your criteria and that you're comfortable with from your risk tolerance. Don't just go gung-ho investing in the first deal you see or investing in a risky deal just to get the tax savings.
Yeah, totally agree. Totally agree. Yeah. And I would like to address even just one of the common misconceptions in this area too is that what Tom's talking about is syndicates and funds, you're going to be a limited partner, right? So you're not going to have really any hours in that specific investment. But with that 500-hour material participation test, if we use a grouping election, we can group those limited partnership investments into your rental properties that you own 100% of, for example. And where this often gets confused is there is a section in the code that says that your participation as a limited partner will mean that you are passive basically no matter what. And I say basically because there's always an exception to the rule, right? But there's a specific exception in the Treasury regs that says if you are using the 500-hour test for material participation, that is the one way to work around that via the grouping. So specifically, you can't be using 100 hours and more than any other individual material participation test to be able to do this.
Right.
It specifically calls out that 500-hour material participation test there. But you've got to jump through all the exceptions to find that.
Exactly.
So in case you hear contrary out there, that's why.
No, no.
Okay. Well, yeah. So next thing I'd love to jump into is just another one of the fun updates from the One Big Beautiful Bill too, is that we had an increase to the SALT cap. That's the state and local tax. For those who aren't familiar with the acronym SALT. But this went from $10,000 up to $40,000, but they put a little bit of a twist on it. Your AGI has got to be below $500,000 to get that full $40,000 state and local tax deduction, that higher threshold. So there is a phase out range from 500,000 to 600,000. And I should say, I'm talking married filing joint numbers. This gets cut in half if you're single. But for married filing joint, that phase out's from 500 to 600,000. So when we're talking about all this kind of stuff year end, fourth quarter, when you're analyzing this, and this is again why you'd want to talk to your tax advisor in a lot greater detail on this, is to find out if you're in this range. We've been talking to a lot of clients that are in the, anywhere from the 500,000 to $650,000, $700,000 AGI range to say, okay, how can we get this down below the $600,000 phase out? How can we get it all the way down to 500? Because obviously, if you're at a $600,000 AGI and we're able to generate $100,000 of losses and offset W-2 income, that's great. We're saving roughly 32% on that $100,000 savings. The great thing with this, though, too, where this kind of adds even more weight to it, is that also might be increasing your itemized deductions from 10,000 all the way up to as high as 40,000, especially if you're in a state that has a high income tax rate like California, New York, or you just have high property taxes that you're paying a lot, through, let's say Texas doesn't have any income tax, but has really high property taxes. So it's definitely something to keep an eye out for if you're anywhere in that range. If you're below 500, great. Yeah, you get to tap into up to that maximum amount already, and you don't have any limitations there. But just wanted to at least squeeze that here in the middle while we're talking about some of the extra benefits to getting these additional deductions at the end of the year.
Definitely important to know. Definitely important to know and keep in mind. That is good. A lot of people battled out that SALT tax update. All right, we're going to move into some of the more normal stuff now, I guess the usual type of stuff that you might see. So tax loss harvesting. So basically what happens is if you have assets that are in a loss position, especially equities, you could potentially sell them this year, recognize a capital loss, and you can use that capital loss to offset capital gains from the sale of other capital assets, be it stocks, real estate, what have you, and up to $3,000 of that can be offset against your W-2 income. And any remaining loss does carry forward. But when it comes to tax loss harvesting, of course, again, I'm going to say this a million times here on this episode, Do not let the tax tail wag the dog, right? You have to understand timing, the wash sale rules. If you buy it back within 30 days, then you don't get to recognize the loss. That's something you have to keep in mind there, but it is a year-end strategy. Some people do sell their laggards or whatever for the year, lock in some of those capital losses before the year ends. Any comments on that, Justin?
Yeah, just comment that to that point, there's this could even be like a creative solution to something like a failed 1031 exchange that you had earlier in the year. Like Tom said, if you have a big capital gain event, it could come from real estate, but you can generate capital losses from selling like securities, or maybe you picked the wrong type of crypto,
Right, right, right.
for example, and you have a large loss, capital loss there. And that can be, or maybe you're under a 1031 exchange right now and you're really worried about, it failing because you're on your third replacement property or something. And maybe you have this, again, planning opportunity for the end of the year
Right,
that, hey, hopefully 1031 works, but let's get the safety net set up. And
right.
if we have some of these capital losses, we can secure now before the end of the year.
Right, right, for sure. For sure. Okay. Then we have retirement accounts. Okay. Some of this basic stuff, right? So retirement accounts, for 401ks and I'm pretty sure 403bs and all that stuff. You have to make the employee contribution prior to the year ending. So meaning prior to 12/31/2025.
Mhm.
You need to speak to your employer or whatever system that you're using for your 401k and make sure that you're making any of those employee contributions before the clock strikes midnight on 12/31. Okay. Whereas for IRAs, okay, IRAs, whether it's Roth, traditional, whatever, those individual retirement accounts, typically you're able to make the deduction or make the contribution to the account up until 4/15 of the following year. So 4/15/2026. So those don't need to be made before year end, but you just keep in mind the differences there. Anything you'd want to add in there, Justin?
Yeah, I'd say the other little, like, I guess, caveat to that is where I'd say like falls in between the two things Tom was just describing there too, is that if you are self-employed, whether you've got just a sole proprietorship, like a Schedule C type of business, or if you have an S corporation, then you'll have like opportunities there for making like SEP IRA contributions, or it could be solo 401k contributions. And to that point, if you're making like the solo 401k contributions, to Tom's point, is you're the employee, but you're the employer as well. You need to make those employee contributions still by the end of the year, but your employer portion of the contribution could be up to the deadline of, say, like your S corporation filing deadline, which would be March 15th. Similarly, if you're just like a Schedule C type of business, sole proprietor, so you don't have a corporation, but you're making something like the SEP contributions, those would be up to your, again, filing deadline for your business, which in that case would be April 15th, because your business gets filed, your Schedule C gets filed with your personal return. That's another one where again, we're like, we can say this probably 20 times on here, is like, you definitely want to talk to your advisor on this, because there's all these different scenarios and exceptions to what type of business do you have, and what does its filing requirement look like? And, do you have the right like retirement plans like set up and everything at the appropriate times?
Yeah. Yeah, no, for sure. Definitely want to make sure you have those nuances ironed out, making the right moves there. Touch on health savings accounts, HSAs, right? So if you're eligible for an HSA, you can make the contributions up until April 15th of 2026, much like an IRA. However, you do have to have the account open and established within 2025. So you have, a few more weeks here by the time this is going to be airing, roughly 2 months to get that done. Don't wait till the last minute. I remember somebody years ago waited till 12/31, so New Year's Eve, to try to get something like this done and was infuriated when they found out that the person had left for the day at one of these companies. Don't wait till 12/31. Get this done now. Don't drag your feet. There's no need for it. So the max HSA contribution is $8,550 if you're for a family plan, if you're under that category, or roughly half that if you are single. Anything there, Justin?
Yeah, no, I'll reiterate that timing at the end of the year. Definitely don't wait till last minute. I compare this to if you've ever closed on a piece of real estate in that window of December 20th to December 31st. And I'm speaking from experience of I'll never do that again. There's a lot of people in this professional like service industries that are not in the office, or like for the majority of that time. So definitely try and get that knocked out at the latest, like beginning of December or
Yeah,
something,
yeah.
for
Kind of
sure.
once you kind of get into that last week or two of December and that holiday season, like all bets are off. You're gambling. You really need to get stuff done before that. Okay, a few more things. Of course, you want to get your documentation in order prior to year end. Get everything organized sooner rather than later. It's not something you want to be piecing together during tax season when there's a lot of stuff going on and there's a lot of information you need to provide your tax preparer. And also bookkeeping, right? Bookkeeping. super important. It's the foundation of the numbers behind your business. It's how you tell whether or not your business is profitable. It's the foundation for calculating almost all KPIs related to your financials, but also for tax purposes. It's one of the things that your tax preparer is going to need in order to prepare your tax returns. And if you don't have your bookkeeping ready, you can't file your tax return. So the sooner you get that in order, the sooner you get that organized, the better off that you are. And that is something that we can help you with as well. And I'm sure we're going to be doing a ton of year-end accounting cleanups and setups as we kind of move into the rest of Q4 here. So that is something that you're interested in. You can follow the link in the show notes to this video or to the podcast, wherever you're tuning in, to schedule a discovery call with our team. We'd be more than happy to see how we can help. But Justin, anything else that we've not covered or that you think is important to cover here on this episode?
Yeah, I think this is sort of year end, I would say, related type of information slash January. Like a lot of our clients will deploy the strategy for shifting income to kids, like paying kids out of your rental business, for example. Great strategy, love it. We've done like dedicated episodes on mechanics on this and everything, so I won't go into full details on this, but real high levels. Keep it reasonable. Like I don't want anybody to hear this and say like, oh, I should go out and pay my kid $10,000 before December 31st. And they're only 5 years old and they didn't actually work in the business. Don't do that. Then definitely make sure that it's if you have been doing it throughout the year, at least for having that documentation ready, is making sure that you do have some record there of the type of work that they did, the number of hours that they spent, so you have that substantiation for what you paid them. But going into January, why I say it's quasi year end slash January, is that if you were paying your kids through your business, and again, assuming that you did this correctly and you didn't do it through a corporation, you did this through like your LLC, that's your rental holding company, for example, you would still want to file a W-2 for them in January. And the deadline for that filing is January 31st. So that it kind of sneaks up on everybody that last kind of all year long you've been maintaining documentation. Just want to make sure you issue them a W-2. Even though you ideally had no withholding on their income, again, if you executed the strategy correctly and did it through the right entities, just don't forget to file that W-2 in January. And, that can be done electronically. We regularly recommend Avalara recently bought out the Track 1099 folks. That's the one we used to recommend, but so use Avalara now just to get that electronic filing done. It's relatively quick and painless. So that's kind of a buttoning up your year-end documentation, I would say.
Yeah, and I'm sure your communication from us via newsletters and whatnot, for those who are subscribed to the newsletter, link is in the show notes, by the way. But 1099s are also due on the 31st of January. And so you want to make sure you get those done. Track 1099, free shout out for them. They can be an effective solution for that. So Justin, when it comes to S corporations, people owners, I know there's reasonable comp considerations around year end. What do people need to consider there?
Yeah, definitely. Again, have that conversation with your tax advisor, tax planner, your CPA or something around like reasonable compensation, and just make sure that, and especially if this is something that you're hearing about, like you had an S corporation set up, earlier this year, and you're going, what in the world's reasonable compensation? That's the quick and dirty there is like, as an S corporation owner, you have to draw a W-2 salary from that S corporation. So you'd want to make sure, and again, we're talking about this in October. So it's kind of short notice, but you could still get this set up if you don't have payroll set up at all. Is that you could get that set up before the end of the year and process yourself a W-2 wage payment. And the thing that you have to be like, keep in mind though, with that too, is that if you have had this S-corp for the entire year, you would basically need to like true up your wages. Like you don't want to just pay yourself like a $5,000 W-2 paycheck, for example, in December and call it good. You don't want to look at that, analyze what your wages should have been for the entire year. And if that's $100,000, then you ideally would need to pay yourself that W-2 wage $100,000. Now, yeah, obviously you got to have those conversations around like how much, cash does the S corporation have in its bank account? Like, what do we need to do to fix that? But just make sure that it gets processed before the end of the year is really, really critical, because having no wages or underpaid a reasonable comp wages for a S corporation officer is a pretty big red flag. So definitely you want to get that in if you can before the end of the year, and have those conversations around like, hey, if you were just paying some random out of the blue flat dollar amount, you want to have that conversation again with your tax planner for the end of the year. Make sure it is something that's that you can document on why you think your reasonable compensation should be that much. The other last like quick little thing I'll mention on that is if you're hearing this and thinking like S corporation, what's the deal? What's the benefit? There can be some pretty hefty tax benefits there with S corporations, most notably reducing your self-employment tax. So if you have like Schedule C business, sole proprietor type business, or, single member LLC that you're running all this through, and you're just now learning about it, kind of hearing about it, late in the game. Unfortunately, in most situations, you can't go back to the beginning of the year to make that change. But at least what you can do, like my recommendation for a lot of clients that are asking us about these this time of year, is say, hey, it's a shame like you didn't know about this, or you weren't working with a group like us to do planning a year ago. Is let's just get ahead of it for next year, because you could go ahead and take care of making the S corporation election now and just have it be effective for January 1, 2026, and not have to worry about hitting the deadlines for that S corp election filing next year. So at least you're not in the same boat come fourth quarter of 2026.
No, important stuff. All right, so I think we covered a lot on this episode. Now, this isn't a full teardown of every little possibility, every little possible thing that you could potentially do. So you definitely want to make sure that you speak to your tax advisor about anything else that you might be able to do for your end, as well as how this all fits together and makes sense for your situation, okay? The devil is always in the details, and don't want to make any missteps or make any major investments thinking that the tax benefits are going to be there for you when there might have been a detail that might be missed and you can't proceed in the way that you thought. So thank you, everybody, for tuning in. We'll catch you on next week's episode of the Tax Smart REI Podcast. The Tax Smart Real Estate Investors Podcast is for general information purposes only and is not intended to provide and should not be relied upon for tax, legal, or accounting advice. Information on the podcast may not constitute the most up-to-date legal or other information. No reader, user, or listener of this podcast should act or refrain from acting on the basis of the information on this podcast without first seeking legal and tax advice from counsel in the relevant jurisdiction. Use of and access to this podcast or any of the links or resources contained or mentioned within the podcast, show, or show notes do not create a relationship between the reader, user, or listener of the podcast and the host, contributors, or guests. Any mention of third-party vendors, products, or services does not constitute an endorsement or recommendation. You should conduct your own due diligence before engaging any vendor. For more information, reference the show notes or description of this episode.